All right, good afternoon, everyone. Thank you for joining us for today's webinar on the One Big Beautiful Bill Act. Just a little housekeeping before we begin. Please use the Q&A panel, not the chat panel, to ask questions. We will go through the questions at the end with Helen and JT. Any questions we don't get to, we'll respond to and send out responses afterwards. Please use the chat panel if you need to chat with me about any technical issues with the presentation. Everyone will be muted throughout the presentation and video will be turned off for all of you. To listen in, you can call in using your telephone or connect using your computer. Instructions are in the email invitation. The webinar is being recorded. We'll send out links to the presentation, the recording, and responses to questions within 24 hours. We wanted to give you a little overview of the firm, including our 4 offices and 5 practice areas, and to quickly mention that some of the topics are related to estate planning, so it could be beneficial to speak to one of our wealth management team members if you already don't have a financial advisor, and your tax professional can make that introduction. That said, I'd like to introduce members of our tax team, Helen Johnson and JT Forbes.
Welcome for joining us for our SDMare webinar. My name is Helen Johnson. I've been doing tax for a long time. I've gone through several public accounting firms. I spent some time at Franklin Templeton Investments. I'm the partner in charge of tax here at SDMare, and I've been with SDMare since 2021. So welcome, and I'll let JT introduce himself.
Thank you, Helen. I'm JT Forbes. I'm a senior tax manager here at SDM. I work on individuals and businesses, and I have a niche area of equity-based compensation. I'm out of the San Francisco office, and I'm a proud member of the Rotary Club of San Francisco. It's the second oldest Rotary Club in the world. So if you're a Rotarian, shout out to you on this call. Next slide, please, Greg. All right, so welcome everyone. We know that you could have flown with any accounting firm today, but you chose to fly with us, so we appreciate that. And speaking of flying, we're going to fly through these tax provisions in the new One Big Beautiful Bill Act signed on July 4th, 2025. Now, we're only going to hit the highlights that we believe are going to affect our clients the most. But, please realize, and I'm sure you do, there's more to this bill than just the tax changes. There's defense spending, there's Medicaid changes, but we're only going to focus on the tax aspects here. So I'm going to cover the individual tax provisions, and my colleague Helen will go over the updates on the business side. And like Greg said, we'll end with some Q&A if we've got it. So let's go ahead and get into it. Now, to understand the new tax bill, you have to kind of recall the old tax bill from 2017. And when that's known as the Tax Cuts and Jobs Act, or we often call it TCJA. That tax bill set many of the tax laws that we know today and left us with a lot of questions on what would happen with a lot of provisions because they were going to sunset in 2025. Well, with the new tax bill, a lot of those questions have been answered by either extending or enhancing or eliminating provisions altogether. Now, so what changed? The current tax rates are now permanent and won't go back to the pre-2017 tax days where the top tax rate was 39.6%. So the highest tax bracket is going to remain at 37%. Now, when I say permanent, it's only as permanent as the current administration. The next administration may decide to change it. So when I say permanent, just take that with a grain of salt as we go through all these provisions today. The tax brackets have also kind of widened a little bit. They always widen a little bit in their index for inflation, but it's a little bit more than we expected, but it's nothing dramatic, nothing significant. So when I say they've widened, it's nothing to write home about. And as we state here, most households earning under $100,000 are expected to save 12% from tax cuts. But keep in mind, those in the higher tax brackets, let's say 300,000 plus, you shouldn't expect this type of tax savings. Well, why not? Well, because those in higher tax brackets are going to experience something called income limitations and phase outs. What does that mean? An income limitation means anything above a certain dollar amount will eliminate the tax benefit altogether. And a phase out, it's a little bit of a softer landing. And as your income starts to go up, your tax attribute starts to go down, and it'll get either eliminated or reduced to some type of minimum. So just kind of keep that concept in mind as we go through the rest of these provisions. Now, the standard deduction, it's now permanently increased and indexed for inflation. Personal exemptions remain gone. So you may recall before 2017, you would get your standard deduction and you have a personal exemption for everyone in the household. But exemptions were removed in 2017 with the TCJA, and we all got larger standard deductions to make up for it. Now the bill just makes these larger standard deductions permanent. And with seniors, people that were 65 plus, you always got a boost in your standard deduction. Currently, that boost is 1550 per person, so 1,550 per person. You still get that in addition to your standard deduction. So if for married folks, it's going to be 31.5 for 2025, you would include an additional 1550 per person on that. Next slide, please. So let's continue on with some of the benefits for seniors. These are 65 plus. Now, remember when I said personal exemptions were gone or eliminated? Well, I may have fibbed a little bit there depending on what they ultimately call this new tax provision. It's this new seniors deduction that is an additional $6,000 per person, and it's on top of your standard deduction. It'll act very much like a personal exemption, and it's going to be subject to income phase outs, which means your $6,000 will start to be reduced as soon as your income goes above $75,000 for a single individual and $150,000 for a married couple. So the phase outs start to happen pretty quickly. So the government giveth and can take it away pretty quickly, given depending on your amount of income. Now, in addition, no changes to the Social Security taxability formula. Yep, there's a formula of how we determine what's taxable. And in some cases, 0% of Social Security will be taxable. But those with higher incomes, they're still going to probably be subject to some type of tax on their Social Security. And at max, it's going to be limited to 85% taxability. And this is because a lot of seniors have additional income beyond Social Security. They've got interest, dividends, rental income, whatever it may be. It's going to drive them higher and start kicking them out of the non-taxability of Social Security. So while the deductions should work for a lot of seniors, probably the only ones that are only making Social Security and a little bit of investment income, the ones with higher income should still expect to pay something on their Social Security benefits. Next slide, please. All right, the SALT deduction. Let's talk about it. State and local income tax. Since 2017, your SALT deduction has been limited to $10,000. That meant no matter how much state taxes you paid, either withholding, estimated tax payments, real estate taxes, DMV fees, all of that, you combine it all together, it was limited to $10,000. And that was it. And the limitation caused a lot of strife here in California, of course, because we pay high property taxes, but also across the nation. It even caused some type of workarounds in the business world by creating something called the pass-through entity tax, also known as PTE. And Helen will talk a little bit more about this later. But using the PTE would allow an entity, an S Corp, an LLC, a partnership, to pay state taxes on your behalf through the entity and allow a deduction for those amounts on the entity's federal tax return. This meant it reduced your share of federal income on your K-1. As long as that reduction exceeded $10,000, you beat the system and you deducted more than the SALT limit, and you still got your SALT limitation. So it was a great workaround. But because of a lot of complaints and a lot of workarounds like the PTE, the SALT limitation was raised to $40,000 now instead of the $10,000. And it's retroactive to 2025, so it starts right now. But keep in mind, this also has an income phase out. So for those of you that are making over $500,000 per year, it's going to start bringing that $40,000 back down. And it's going to phase out pretty quick. So as soon as you get to 600,000, it comes back down to 10,000. So you'll at minimum always have $10,000 as a state and local income tax deduction. But if you're in the higher tax brackets, it's going to be back to where it was at 10,000. But those under that, well, then we should see some type of benefit. And keep in mind, this threshold is the same for single and married folks. So it doesn't mean that married folks get to double that threshold. It's the exact same here. Charitable deductions. Now, starting in 2026, we now have a hurdle to clear for donations. You'll need to donate more than 0.5% of your AGI to deduct charitable contributions. It's very similar to how medical deductions work. If you remember, you would have to clear 7.5% of your AGI, and anything above that become a medical deduction to you. And nobody could get it because it's very difficult to clear 7.5% of your AGI. So that means that if you make $100,000 per year, you need to donate more than $500 to receive tax benefit if you itemize. So if you donated $2,000, your deduction is only going to be $1,500 because of that $500 floor now. So there's some workarounds here that you can consider. And one is for, again, for the seniors that are taking the required minimum distributions from their IRAs. You can elect to donate up to $108,000 directly to the charity, and it eliminates the taxability of your RMD, of course. And that will avoid the 0.5% floor because that gets reported on a different section, not on Schedule A under itemized deductions. This is known as the qualified charitable distribution. You may hear it as the QCD. So you can do that. You may also want to consider front loading your donations and put them into something that we call a donor advised fund. We often refer to it as a DAF in 2025. Think of a DAF as your own private foundation, but without all the complexity. You donate cash or long-term appreciated assets like stock, and then we get a deduction for the fair market value on the date of contribution. In addition, you don't have to pay the capital gains on that appreciation on that stock. And then you can distribute the funds at a later date or even at a later tax year. But we're not going to get another deduction when you actually donate it. It's on the day of contribution and that's it. So if you do this and you do it all in 2025, you're going to avoid that floor. So sometimes when we say we have clients with a big income year, we ask them, maybe now's the time to consider making a donation. And this would be the year to do that. If you need to learn more about DAFs, we have wealth advisors on staff. You can email us and we can forward that on to them and you can talk it out. Now, further, for those that don't itemize, you're still going to get some type of deduction for donations. And so it's going to be an above the line deduction for you. You're still going to get your standard deduction, but you're going to be limited to $1,000 for a single person and $2,000 if you're married. Next slide, please. All right, car loan interest. Now, this is a new deduction for the interest on car loans, but it's going to be limited to $10,000. And it has an overall limit. So it's not per vehicle, okay? So you can't have 10 vehicles and deduct 10,000 per vehicle. But it's going to have a phase out starting as early as $100,000 for single folks and $200,000 for married individuals. So we aren't sure how the car industry is going to handle this, but we assume you're going to receive some type of form very similar to your mortgage interest statement, a Form 1098. But we'll see how they decide to handle this. But that being said, I'm also seeing a lot of 0% deals, interest rates on cars right now. So is it going to be a lot of benefit? I don't know. That's for you to decide. Mortgage interest, nothing's really changed here except that this has just been made permanent. You still have the $750,000 limit on deductible interest on loans and the $1 million, but the $1 million was for folks that started their loans before December 15th, 2017. Itemized deductions limit. Now, you may remember back before 2017, we had an overall itemized deduction limit. It was about a 3% haircut on all your itemized deductions, and it affected people that were in the 33% tax bracket and above. And then it went away when we had the TCJA, but now it's back in a different form, of course, and it's only going to affect people in the 37% tax bracket. So what the new law says is that if you're in the 37% tax bracket, you're only going to get benefit of 35%. So when we tell clients that are in the 37% tax bracket, if you make a donation, you'll get 37 cents on the dollar because that was the 37% tax bracket as a deduction. Then now it's limited to 35%. It's just this 2% haircut for those in these higher tax brackets. And keep in mind, this is also going to be after the SALT limitation and after the charitable contributions limitation floor that we just talked about. And for those that want to know, the 37% tax bracket, it starts at $635,000 for single individuals and $763,000 for married folks. So if you're getting it up above there, you may want to consider doing some type of tax planning this year as opposed to next year. Next slide, please. All right, no tax on tips and overtime. Let's take them one at a time. We'll do no tax on tips. So this is a new deduction of up to $25,000 for tips starting in 2025 and ending in 2028. So ending in 2028 looks like another sunset date. So what happens after 2028? Well, we're going to all have to stick around and find out. But this is going to be for occupations that traditionally and customarily receive tips. Sadly, your favorite accounting firm doesn't receive tips, but during tax season, we do love the treats. Chocolate's a favorite, if I'm going to plug anything. But this bill places responsibility on the Secretary of Treasury to provide a list of those professions that's going to qualify for this thing. And while the 25,000 won't be subject to income tax, it's still going to be subject to payroll taxes. So you're still going to get hit with the Social Security and Medicare tax on these things. And it should be separately reported on your W-2 or 1099, whatever you end up receiving. But just like everything else, this is going to have a phase out. And so this phase out here starts at $150,000 for single individuals and $300,000 for married folks. So once you start to go over those, that $25,000 is going to start coming down. Now, no tax on overtime, very similar concept as the tips, except this one's in half. It's 12,500 is what this deduction is going to be. It'll also be reported separately on your W-2. And so they typically are going to define overtime as hours above 40 hours per week for non-exempt employees that are on an hourly basis. And the phase outs are going to be the same here. It's going to be 150,000 for single folks and 300,000 for married folks. And so hopefully we're hoping, the accounting firms are hoping that payroll companies handle a lot of this before it even gets to us. So good luck. I don't know how they're going to track all of that. Education savings accounts. So this bill expands what you can spend the 529 plan amounts on, and it includes K through 12 and vocational training. Before, you could only use $10,000 for primary and secondary school, but now it's up to $20,000 and you can spend it on more than tuition. But just know if you start drawing from these accounts early, you're really limiting the amount of tax-free growth that's going to be available for college. So what are some things that people can do here to avoid it? Well, grandparents, right? Your grandparents are always wonderful people when they're willing to contribute to college. And so your grandparents can do something called super funding these 529 plans. And so what's super funding? So we're all allowed to give $19,000 per person per year and not pay any gift tax on any of that. And so what you're doing is you're taking 5 years worth of those $19,000 per year, and you're doing it all in 1 year into a 529 plan. So that means that grandma can put in $95,000 for this child, and then grandpa can put in another $95,000 for the same child, and suddenly they have $190,000 of funds to be able to go tax-free if they spend it on college in the future. The advantage here is that you're maximizing the 529 growth for college, and it doesn't go against your lifetime gift limit. However, if you do these super fundings, you still have to file a tax return called the 709. It's a gift tax return. It's more informational than anything, but it's something that we can handle and do if you decide you want to do this. Now, speaking of gifts, we now have a lifetime gift exclusion raised to $15 million starting in 2026. As I mentioned, you can give up to $19,000 per year per person tax-free, and it doesn't affect this $15 million. But if you give more than $19,000 in a single year to a single person, you start to eat into that amount. And then we report that on the same Form 709 and tell the government that you're starting to use a lifetime exclusion. If you give nothing away during your entire lifetime and you leave it to your estate, well, the first 15 million of your estate will be tax-free, and the remainder, anything above that amount, may be subjected to estate tax of up to a rate of 40%. So this is why your estate tax planners and attorneys are trying to get things out of your estate because they want to help you avoid the estate tax. Now that 15 million will be adjusted for inflation every year. We're just glad it stayed at this level because pre-2017, it was around 6 to 7 million bucks. And we thought it was going to go back to that. But now this is with the new bill, it's concluded to 15 million. Now for 2025, the lifetime gift exclusion for this year is 13.99 million. So if you wait 6 months, you get another million at 15 million. So if you can wait 6 months to die, you just saved a cool $1 million, and you're welcome for that tax planning tip. Next slide, please. All right, qualified small business stock. QSBS is how we talk about it. This area has really expanded. It gives more people an opportunity to take advantage of the QSBS rules. And what are QSBS rules? Well, it's stock that you acquired from a company with its original issuance. A company had under $50 million of assets at the time that you acquired it, and you held it for 5 years, and there's a couple of other requirements. But if you met all of that, you could exclude up to 100% of the gain, up to $10 million. Great. If you had it, it was wonderful. It's a wonderful tool that you can use. But in California, keep in mind, because we're in California, California does not recognize this tax law. It used to a long time ago until somebody challenged it. And then California decided, all right, well, nobody gets it. So it's still going to be taxable here in California. So if this is you, with somebody with potentially QSBS, let's talk about you moving out of the state before you pull that transaction, because we want you to live in a state that's either recognized as QSBS or maybe it's a no tax state. Now, usually this type of stock shows up in startups, and it's for founders, venture capitalists, and early employees of the company. So with the new tax bill, the stock acquired after July 4th, 2025. So this is only anything acquired after July 4th, 2025. You can now benefit from QSBS even partially after 3 or 4 years. Remember, you had to hold it for 5 years. Now they've got some type of scaled down provisions where you can hold it for 3 years and get some type of benefit. And the company asset requirement went from 50 million to 75 million. So I fully expect to see a lot more folks here with QSBS treatment. Opportunity zones, these things still exist. You may remember it was a vehicle that was created with the TCJA where you could defer capital gains by investing in one of these funds. You would sell your stock, you had gain of $100,000. You put $100,000 into an opportunity zone fund, and you got to kick the can down the road, but you can only got to kick it down until December 31st, 2026. You always had to recognize the gain on December 31st, 2026. So if you're in an opportunity zone, just know you're going to have this taxable event December 31st, 2026. So the new law keeps opportunity zones around. It just says you can still do them, but the way you're going to recognize the gain is that it's going to be the earlier of you exiting or 5 years. So you're still going to be able to recognizing some type of gain. Reporting thresholds. This is one of my favorite ones. This is for 1099s. Remember, we would always tell you, hey, did you pay somebody over $600? Well, you have to send them a 1099. And now that $600 is gone from $600 to $2,000 per person. So this should alleviate a lot of 1099 reporting by us, by you. It should alleviate the IRS from having to deal with them. So I think this is great. If I could, I would raise this even higher because it's just a lot of legwork to get 1099s done. But I think since I started my career, it's always been $600. I don't think it's ever gone up. So this is great for me. All right, repealing of certain credits. So this is where we're going to talk about the EV credit and solar. So the $7,500 EV credit, it's ending September 30th, 2025. Let me repeat that, September 30th, 2025. So if you're looking to buy, if you're on the fence, buy it now. But remember, these do have income limitations here. So once you go above $150,000 as a single person or $300,000 for married individuals, you don't get the credit. So keep that in mind. So if this is something that you think you're going to be doing and you're going to meet the income thresholds, go for it. But just know everybody else is going for it right now too. So solar credits, those are going to end December 31st, 2025. So by the end of the year, these solar projects that you may be working on for the house, they've got to get done by the end of the year. That means it has to be up and running and placed in service by then. Doesn't mean that you can pay for it in December and then have the work done in January of 2026. If that happens, it just won't qualify for the 30% credit. But again, it's ending by the end of the year. So I'm sure a lot of solar companies are people making a run on them right now. So if you're one of them, everybody's pushing to get it done by the end of the year. And then finally, this is not on the slides, but there's something called Trump accounts. These are new. They're going to work something like an IRA, and they're going to be funded with after-tax money for those that are under 18 years old. So in addition to that, if you're born between 2025 and 2028, the government's going to give you $1,000 to start those things. And parents and grandparents can contribute a maximum of $5,000 per year. It's an absolute maximum. So it can only be $5,000 per year. So this is going to be in an attempt to get kids to invest early. As we all know, investing early, they're going to see the most gains. Uh, but it's the mechanics of it. They're new accounts. They look a little bit difficult to track and manage. So we'll see how they're going to ultimately progress as guidance comes out from the IRS. So that's it for the individual provisions on my side. I'll send it over to Helen now so she can update you on the business side. Helen?
Thanks, JT. So, the biggest change happened actually back in 2017 with TCJA, really on the business side. So, the huge change there was the drop in the corporate tax rate to a flat 21%. Before that, it was a graduated increase, but it set the limit at 21%. And as a result of that, there was new legislation that was created called the Qualified Business Income Deduction, or it's the Internal Revenue Section 199A. And that basically gives you a 20% deduction for income from partnerships and S corporations. It goes through a lot of complicated calculations, but at the end of the day, it's designed to basically give you a 20% deduction. That was going to sunset at the end of 2025. It is no longer sunsetting. It's here to stay along with the 21% corporate tax rate. There is a new component here for small taxpayers, and that's if you have $1,000 of qualified business income from a trade or business, then you get a minimum deduction of $400. JT alluded to the pass-through entity tax in his presentation. So again, one of the things that TCJA did was it limited the uh, SALT deduction to $10,000, whereas before that, taxpayers were allowed to take a lot more for state tax deductions. And so there was a workaround that was created by various states, and the workaround is called the pass-through entity tax election. And for many of my clients, we work together to make sure that you take advantage of this, because what this allows you to do is it allows you to take a state tax deduction against ordinary income. And the way that falls on your tax return is that it goes into AGI. So, to the extent that you can make AGI as low as possible, that's always to your benefit. And while the salty deduction has gone up, there's also been a, reinstitution of the limit on the itemized deductions. I think the best way to get a deduction is always above the line. And the pass-through entity elective tax allows you to do that. So we can certainly run some scenarios if you think that maybe it is not as beneficial for you now because of the increase in the SALT deduction. So reach out to us if we haven't reached out to you. So there are a lot of changes in the tax legislation as always, and I think what we're highlighting here is some things that we think would apply for many of our taxpayers, or in my case, it's just kind of interesting. So, well, the 100% bonus depreciation certainly benefits many of my taxpayers, many of my clients, and there was always a question with TCJA, what was going to happen to the 100% bonus depreciation. It was tearing down, it was going from 100%, 80% to 60%. And in 2024, it's 60%. And without the passage of the Big Beautiful Act, it would have gone down to 40%. Now, because of the passage of the Big Beautiful Act, we have bonus depreciation again, and we don't have to worry that it's going to go away. However, as with tax legislation, there's always a little quirk. So if you placed an asset in service between January 1 and January 18th, it's still 40%. Tax law does not make sense. And certainly here is an indication, one of those examples. Other depreciation limitations went up. The Section 179 expensing limit pretty much doubled. It's going to be $2.5 million in 2025. It's going to phase out at $4 million. With Section 179, if you can't create losses with Section 179, So with most of my clients, I usually encourage them, or I usually try to take the bonus depreciation rather than doing Section 179. But again, this is an analysis that we can help you with. And with all tax law, this is the IRS only. So when you think about doing a tax return, you have a federal return and you have a California return. Well, we have some changes for the rules for the federal return, but no changes on the California return. And it's nowhere more prevalent. I mean, it's most obvious when you look at the Section 179 limitations. So for federal, it's going to be $2.5 million expense, $4 million threshold. For California, it's still $25,000 with a $200,000 phase out threshold. So you can see the discrepancy here. Um, there is a new class of asset that was created for 100% bonus. I don't think I have many clients that for which we could apply this, but it is non-residential real property in the US. So think of a building that's used for manufacturing, agricultural, or chemical production or refining operations. So if construction begins between January 19th, 2025 and 1/1/29, and if you place the asset in service, meaning, get it all ready and have it ready for business by 2031, then you get the 100% bonus for federal only. Okay. The the next, I think, more meaningful change in legislation for most of my clients will be the change in the R&D credit. So we can expense the R&D credit now as we could back in 2021, and that starts with 2025. So we don't have to worry about capitalizing, sorry, not R&D credit, but R&D expenses. We don't have to worry about capitalizing R&D expenses and amortizing them across 15 years. We still have to do this for foreign research and development costs. So this expensing provision is only available for U.S. R&D costs. Now, there is a mechanism, there are mechanisms for trying to recapture. Actually, recapture is not a good word. That's a very special word in tax, but there are a couple of ways where since you were forced to capitalize and amortize, you can kind of claw that back. So if you're a small taxpayer, and small, I think, is defined pretty large, so $31 million or less gross receipts in 2025, you can actually go back to 2022 and amend those returns to get refunds. So 2022, 2023, 2024. If you ended up paying tax in those years because you had to capitalize your R&D credits and you couldn't immediately deduct them, you can go back and amend those returns and seek a refund. I think out of all the things that I've read, this seems to be like the easiest way to capture back taxes that you may have paid. But for if you're not a small taxpayer, there are other things that you can do. You can elect to amortize the balance of the unamortized balance of R&D credits across 1 year or 2 year. And if you incur new R&D expenses in 2025, and for whatever planning reason, it doesn't make sense to immediately expense them, you can elect to amortize them over a period of no less than 60 months. So there's some other interesting things. So again, this is very specific to, certain taxpayers. There's something called a business interest limitation. And so the business interest limitation kind of broadly makes sense. So if you take out a big loan and you use some of it for personal purposes and some of it for business purposes, then you shouldn't be able to deduct all of the interest expense. There should be some way to limit that. And there is a calculation to limit that. And the calculation is called adjusted taxable income. But there was a change in 2022 such that you had to include depreciation and amortization in calculating adjusted taxable income. And so what that did was if you had, adjusted taxable income here, if you add depreciation and amortization, it went down here. And so the amount of interest expense that you could take was smaller. Now, with the Big Beautiful Act, you don't have to take depreciation and amortization expense anymore. So you still have to calculate, adjusted taxable income to figure out how much you can deduct as business interest expense, but that number is now a little bit higher. So another thing that was brought in new with TCJA was something called the excess business loss limitation. And so what that did was if you had um, trade or business expenses coming through on your individual return, you could offset it against other types of income, wages, interest, dividends, capital gains. So these typically in tax language, these are not called trade or business income or expenses. Um, they have kind of other names for them. A trade or business income or expense is, as you would imagine, it's an active trade or business where you're actively engaged. So, not real estate, because that's traditionally not seen as an active trade or business for most people, not everybody. Um, but these excess business loss limitations came about in 2017, but now they're here to stay. So the loss limitation for 2025 is $313,000 for a single taxpayer and $626,000 for a joint taxpayer. Disallowed losses do become net operating losses, so you can use these losses in future years. Okay, even as I'm talking about this, it sounds complicated. So if you think that, if you see an opportunity where you're like, oh my goodness, I had this business and I had to sink a ton of money into it and I'm losing money left and right, you can probably, offset those business losses against other types of income. You just may not be able to eliminate it. So, but again, this is probably a situation where you do want to call us. We may not know exactly what your situation is in 2025. Okay, now there are other things that I think are kind of interesting. Meals and entertainment, in my mind, is an area where I wonder why everybody wants to mess with it so much, because these numbers are typically really tiny. And again, the IRS has its own rules and California has its own rules. And now we have a change in the federal rules. So the change in the federal rules is typically meals and entertainment are deductible at 50%. I think most people know this. But now, as of 2026, meals provided for the convenience of the employer will no longer be deductible for the IRS, but they are still deductible for California. Okay, so as I had mentioned earlier, so the big change that came about with TCJA is that the corporate rate went down to a flat 21%. So there weren't a lot of corporate changes. I didn't see a lot of corporate changes reading through the changes for the Big Beautiful Act, but I thought there was one that was kind of interesting. So starting in 2026, charitable contributions have to hit 1% of taxable income before they can be deductible inside a corporation. I always advise my clients, if you happen to have a C corporation for whatever reason and you have your individual return, usually the way, if you want to, donate to a charity, it's best to do it as an individual rather than a C corp, because for a C corp, there's another limitation. It's not new, but you can't offset your, there's can't take more than 10% of taxable income as your charitable deduction for a C corp. And typically, if you have a loss for a C corp, those charitable contribution deductions are really of no benefit to you. So now the ability for a C corp to take a charitable deduction is harder. So I think for huge corporations, I mean, you could argue that it just encourages big corporations to donate more. Um, and that's great. But for many of my clients, they don't have big charitable C corporations. They have small ones, in which case I really encourage you to donate as an individual rather than through your C corp. Um, and there are some other things that seemed interesting. The the paid family and medical leave credit was set to expire at the end of 2025. It's no longer expiring. Um, and there's some other ways to calculate that. Um, so these are kind of provisions. It sounds great, but when you dig into it, you're like, it's a little harder to get. So anyway, if you think that this would be applicable to you, reach out to us. Employee retention credits. Okay, I think the opportunity for employee retention credits has basically disappeared. But if you so the IRS will stop processing claims as of the date of enactment of this law, which was July 4th, 2025, for claims filed after January 31, 2024. So if you filed something in 2024, uh, well, if they started processing it before the enactment, you might get something. But if they haven't processed it by the time this law was enacted, there's no employee retention credit. And the statute of limitations has been extended from 5 years to 6 years. And as JT had mentioned, the 1099 miss and the 1099 NAC thresholds went up from $600 to $2,000. Woohoo! Okay. Now, the other thing that got increased was the 1099K threshold. So this is Venmo, PayPal. Those thresholds were going up and down like this, but now they're set at $20,000 and 200 transactions. So there are a couple of, as JT mentioned, um, energy credits. They're not in vogue anymore, and so these energy credits have various phase out dates. 9/30/25 is one to look out for. 6/30/26 is another one. There was an interesting provision about you could depreciate qualified energy property across 5 years. That is no longer available. There was another interesting kind of code section 179D that said that you could get a deduction for energy efficient commercial buildings, but that's gone after next year, June 30th, 2026. And then there were some international provisions with lots of fancy names that got tightened. So, and actually, that brings us to the end of our formal comments. Um, so we encourage you to schedule a review with us. As you are listening to the webinar, I'm sure that you've had questions, and your primary question is probably, well, how will this new act impact me, my family, and my business? And certainly we are here to help you with that. As things emerge, as updates, emerge, we'll certainly let you know, and feel free to email us. And I think JT is just going to go over some other ways that we could potentially help you.
Yeah, thanks, Helen. Like we understand everyone's tax situation is different, even though some clients don't believe so. Often we'll hear that, hey, my neighbor makes the same amount of money as me, but he gets a refund, I don't. Why not? It's because everybody has a different tax situation. So if you want to know more about these things, all these things listed on this slide here, how it affects you, we encourage you to reach out to your tax preparer here at SDM. But just know we may not have all the answers yet. It's still a new tax bill. There's still a IRS guidance coming. There's stuff coming all the time. So the intricacies of everything we're not sure about yet, because they still have to like solve a lot of questions that we may have. And we all know how fast IRS works. So with that, I see a couple of questions in the Q&A. One for me, it looks like one for you, Helen. And so the question is there an income limitation on solar credits? The answer is no. There's no income limitation. I think the only limitation you're going to have is finding a contractor that's going to get it done by the end of the year. And so I have a client that I contacted yesterday because I know he's in this process. I was like, what did your contractor say? And he's like, he's not sure. So because he's, very busy right now. So we're hoping that he's going to get it done by the end of the year. And then Helen, can you see the other
Yeah,
question
so
there?
I see this other question, which is, are S corps subject to the same updated charitable contribution rules, SE corps? And the answer there is no. So S corps generate K1s, and so to the degree that there's a charitable contribution within an S corp, those charitable contributions will appear on a line on the K1, and those charitable contributions will feed into your individual return and go through the limitations on your individual return. Although I have to say, again, for California purposes, California has that interesting 1% tax for S corps. For that 1% tax, uh, the the charitable contributions will kind of get rejiggered in calculating taxable S corp income for California purposes.
All right, and I do want to remind folks that if you do have questions, use the Q&A panel. We'll give you a few minutes here.
Okay, no questions? Come on. SDMare folks? Oh, is there an age limit for QCD?
Yes, for QCD, it's going to be for people that a minimum age, I believe, is 70 and a half years old. They're the ones that are going to qualify for the QCD. And typically, it's going to be people that are taking the RMD. This is where they're going to distribute from.
We'll give it another couple minutes and then we'll see how it goes here.
Okay, I have to say that I think one of the most interesting things in this tax legislation are the Trump accounts. So I'm curious to see how that would work out. Um, and I think it's a good way to play off the 529 accounts and the Trump accounts. And this is where I would say our wealth management folks can really help you figure out how to maximize both or three things: 529s, Trump accounts, um, and other savings vehicles.
Okay, is there any way that salary employee benefit from overtime deduction? I'm not sure. Can you rephrase that question for me? And then Brian, you've got to qualify for the deduction of vehicle interest. Does the car have to be purchased in 2025, or does it apply to prior purchased vehicles? I don't know. I'll have to look to see if it has to be a new vehicle or not.
But I think it has to be a US. So
Correct. It has to be a
primarily,
U.S. vehicle.
yeah, primarily manufactured in the US.
All right, some more questions coming in.
So I think the Trump account is actually works like an IRA. So you don't get it when you reach 18.
And
Um,
and the question was, can the money in the Trump account be used for any purposes when the child reaches 18?
no, because it's another savings vehicle. It works like an IRA, but not
Yeah,
a Roth IRA.
there's a lot of rules around the Trump account, so a lot more than we could describe here, but
Right,
they're
right.
going to be fleshing a lot of this detail out when they get to it. Do we know if the no tax and overtime will be reflected on paychecks? My assumption is yes. They will exclude it from income tax from box one of your W-2. It'll be separately stated, I'm sure, in box maybe 14 or box 12. But yeah, I anticipate that they'll make the effort to try and make it non-taxable. However, we have these income limits, so how would they know whether you're allowed to deduct it or not? So unsure. And the 1099 thresholds for 1099 MISC, was that going to be also increased to $2,000? I believe that is true. I think across the board, those 1099s are going to increase from 600 to 2,000. Any change in income limits for tax-free long-term capital gains? I assume you're talking about the 0% interest. I'm sure it's always adjusted for inflation, but I'd have to check for you but if you have that specific question about that, just email us and we can talk it out. All right. So Brian, I think your question is, so the business will have to pay Social Security, Medicare tax on that. I assume you're talking about the overtime and the tips. Yeah, it's still going to be subject to Social Security and Medicare. So it's, you'll pay your portion, the company will pay its portion on those that compensation. And yes, it is overtime is up to 12,500. Tips was up to 25,000. All right. Seems like there's a lot more questions that we're going to be able to answer here, Greg. So maybe you can have to forward information to us and we'll try and address them.
All right. Um, let's see. All right. Well, thank you for joining us today. You can contact us anytime using the information on your screen. Also, look for an email in the next 24 hours with additional details on how to access the presentation and recording. So, thank you very much for joining and have a good rest of your day.
Thank you, everyone.
Thank you.